Loss aversion is a cognitive bias affecting financial decisions. It describes the tendency to feel the pain of a loss more acutely than the pleasure of an equivalent gain. This bias means that the negative impact of losing money outweighs the positive impact of gaining the same amount. Loss aversion significantly influences decision-making in trading and investment contexts. Traders and investors may avoid potential losses, even if the expected gains are higher, leading to suboptimal choices. Traders often exhibit reluctance to close losing positions. This reluctance stems from the hope that the stock price will recover. The primary motivation is to avoid acknowledging a loss. Holding onto losing positions can result in greater financial damage. Unwillingness to accept small losses may lead to substantial setbacks. Traders sometimes sell winning positions too early. This premature selling is done to secure profits. Early selling leads to missing out on potential further gains. The primary driver is the fear of losing already earned profits. This fear-driven action limits overall profit potential. The disposition effect is an observed bias in investment decision-making. It involves selling winning stocks prematurely while holding on to losing stocks longer than advisable. This behavior leads to the early realization of gains and the deferral of losses. Such actions can create a tax-inefficient investment portfolio. Some traders attempt to recover from losses by increasing their risk exposure. A common method is doubling down on losing trades. This involves investing twice the original amount in the same asset after a loss. Another risky strategy is taking oversized positions. This means allocating a disproportionately large amount of capital to a single trade. These high-risk approaches often exacerbate losses, leading to further financial strain. Overtrading often occurs after traders experience financial losses. It is characterized by an attempt to recover losses quickly through increased trading activity. These decisions are frequently driven by emotional stress rather than strategic analysis. Emotional decision-making typically results in lower quality trades and further potential losses. The sunk cost fallacy intensifies loss aversion in traders. Traders are hesitant to abandon losing positions due to prior investments. This reluctance stems from a desire to recoup already spent capital. The fallacy compels them to persist, hoping for investment recovery. Regret aversion is an emotional bias influencing decision-making. It is characterized by the fear of making a wrong decision. This fear is often triggered by the potential for future regret. In trading, regret aversion can manifest as reluctance to sell. Traders may avoid selling a losing stock, fearing it will rebound. This aversion prevents traders from cutting their losses effectively. The endowment effect is a cognitive bias affecting trading decisions. It causes traders to overvalue assets they currently possess. This overvaluation makes them reluctant to sell these assets. The reluctance persists, even when selling would be a rational choice. This bias can lead to holding on to underperforming assets longer than advisable. Ultimately, the endowment effect can hinder optimal portfolio management. Status quo bias is a cognitive preference for the current state of affairs. This bias influences traders to favor their existing situation. It occurs even when a change could potentially offer improvements. This inertia can prevent traders from making necessary portfolio adjustments. Ultimately, status quo bias can hinder optimal decision-making in trading scenarios. Loss-averse investors tend to exhibit a consistent pattern of underperforming the market. This underperformance is typically quantified as a deficit of 3 to 5% annually. The primary driver of this underperformance is suboptimal decision-making. These decisions are often heavily influenced by emotional biases. Loss aversion, in particular, leads to choices that prioritize avoiding losses over maximizing gains. This bias ultimately hinders the investor's ability to achieve optimal market returns. Loss aversion can negatively impact risk management strategies. One manifestation of loss aversion is the underutilization of stop-loss orders. Stop-loss orders are designed to limit potential losses on trades. Failure to implement stop-loss orders effectively reflects a lack of trading discipline. This lack of discipline exposes traders to substantial financial risks. Consistent use of risk management tools is crucial for capital preservation. Emotional trading is often driven by fear and anxiety. Loss aversion significantly contributes to emotional decision-making. Decisions are based on emotions rather than rational analysis. This emotional approach leads to suboptimal trading outcomes. Rational analysis is often abandoned in favor of reactive responses. The result is a deviation from calculated, strategic investment. Loss aversion can lead to portfolio imbalances. Investors may hold on to losing assets for too long. This behavior results in a concentration of assets in underperforming positions. Such concentration reduces the overall diversification of the portfolio. Reduced diversification increases the portfolio's exposure to risk. Therefore, loss aversion can negatively impact portfolio risk management. Opportunity cost arises when capital is locked into underperforming assets. This prevents the deployment of capital into potentially more profitable ventures. The inability to invest in better opportunities results in missed gains. These missed gains represent the opportunity cost of the initial investment. Opportunity cost directly reduces the overall return on investment. Efficient capital allocation is crucial to minimizing opportunity costs and maximizing returns. Predefined rules for entries, exits, and position sizing are implemented to mitigate loss aversion. Systematic approaches are used to reduce the impact of emotional biases on trading decisions. These rules provide a structured framework for making trading decisions. The framework helps to avoid impulsive actions driven by fear or greed. This ultimately leads to more rational and consistent trading outcomes. Automated stop-loss orders are employed to mitigate potential financial losses in trading. These orders are designed to automatically execute a sell order when the price reaches a specified level. A key benefit is the elimination of emotional decision-making during volatile market conditions. By predetermining exit points, automated stops ensure losses are limited to acceptable levels. Establishing loss limits is a key strategy in risk management. These limits can be set on a daily or weekly basis to manage risk exposure. The primary goal is to prevent excessive financial losses within a defined time frame. Adhering to loss limits helps maintain capital preservation and financial stability. Adhering to a trading plan is crucial for maintaining discipline in the market. A trading plan helps prevent emotional and impulsive trading decisions. A well-defined plan provides a structured framework for trading activities. This framework promotes rational behavior when making trading choices. By sticking to the plan, traders can avoid costly mistakes driven by emotions. Cognitive reframing is a technique used to change one's perception of an event. It involves reinterpreting experiences to alter their emotional impact. Reframing losses as learning opportunities can reduce negative emotions. This approach promotes a more rational and less emotionally charged perspective. Viewing setbacks as tuition encourages personal growth. This mindset shift facilitates resilience and future success. Effective trading process evaluation requires separating decisions from their outcomes. A well-reasoned trading process can sometimes lead to unfavorable results. Conversely, a flawed process might occasionally yield positive outcomes. Focusing solely on outcomes can obscure the true effectiveness of the trading strategy. Tracking decisions independently provides insights into the quality of the trading process itself. This approach enables traders to refine their strategies based on decision-making quality, not just profit or loss. Mindfulness practice cultivates awareness of one's present state. It enhances the ability to recognize emotional triggers. Mindfulness aids in managing impulsive reactions to stimuli. This practice promotes a sense of calm and focus. In high-pressure environments, mindfulness can help maintain composure. This is especially useful during volatile or stressful situations. Portfolio diversification is a strategy to mitigate risk by allocating investments across various assets. Diversification reduces emotional attachment to individual positions. It minimizes the impact of a single losing trade on overall portfolio performance. This approach helps in achieving more stable and predictable investment outcomes. Effective diversification involves selecting assets with low or negative correlations. Portfolio positions should be reviewed objectively. Ask, would I buy this today at the current price? This question helps determine whether to hold or sell. Decisions should be based on the position's current merits. A trading journal is essential for identifying patterns in biased trading behavior. Analyzing past trades allows traders to recognize recurring mistakes. These mistakes are often driven by psychological factors such as loss aversion. By identifying these patterns, traders can actively correct their behavior. This correction leads to more rational and profitable trading decisions.